So, hello. It's Monday morning. It's 8:30. And that means it's a property finance Facebook Live. So, welcome to whoever's going to be joining me. Quick slurp of water this morning. There we are. So, a sunny Monday morning. And we're ready to answer some Facebook questions. And the point of my Facebook Live is that you pop anything that you want to know about property finance, you pop it in the chat box and then I answer it for you. So, and that's what we do on a Monday morning. So some highs there, some familiar ones there. Hello, Matt. Good to see you. There we are. So what's been puzzling you over the weekend, or maybe last week, or maybe even longer? What's been the thing that really gets you go about property finance? So let's have a chat about that, and I'll answer some questions. So got in with the good to see you there, Peter. Question. We'll look at that in a minute. So a few more people, fire your questions in and we'll have a look and see. Peter's asking about leading times for mortgage valuers. Yep, I know what you mean, Peter. So we'll have a look at that in a minute. Got anything else you want to find out about? Okay, so that's what we're here for. Answer questions. And whether you're watching this live or you're watching it on the recording, because it'll be in my Facebook group, Recycle Your Cash, on the Recycle Your Cash page, on YouTube, and in Kevin Wright, Property Finance Expert, on my Facebook page. So pages, YouTube, whatever. So wherever you are, feel free to pop a question in. That's what we do. So, okay, we'll kick off with Peter's question. So Peter's come in with there. So let's show that. Okay, so what kind of leading times are we looking up for mortgage valuers at present? Well, you know, they couldn't do a valuation for 3 months, could they, Peter? So, you know, they had, I think, somewhere about 60 or 70,000 valuations as a backlog when we came out of lockdown. When was it? June, wasn't it? Sometime in June we came out of lockdown. So there was a big rush to get all that backlog of valuations done. I think they've worked through a lot of that now, but still expect values to take longer. You know, it would be unusual to think they would turn it around, you know. So you'd ask for a valuation, they'd go there the same week and turn it around the next week. They're probably on mortgages, they're probably not yet as quick as that. So if you've got a particular issue, then just ping me a message on my Facebook page, Kevin Wright, Property Finance Expert, Peter, and happy to pick that up with you. But things are, from the valuation point of view, lead-in times, getting back to normal. Of course, bridgers tend to use different types of valuers, so bridgers have always valued faster anyway. And, you know, with a lot of cases, if you want a queue jump and you want to pay a bit more money, particularly with bridging lenders, then you can still get a survey done pretty quickly. So there we are. So good to have your question there. And anyone else that's got a question, ping it in. We'll got one more coming here from a Facebook user. We'll deal with that next. So I'll be here till, I don't know, about 9 o'clock, something like that. That's aim jump on here for a quick half an hour, assuming there's enough questions to keep me occupied for that time, of course. So there we are. Thanks for your question, Peter. So here we go. On a refurb bridge, after valuation of work done, how long does it take to get the funds released? Yeah. Okay. So on a refurb bridge, and if anyone's watching this live or recorded and you're not quite sure what a refurb bridge is, then I'd refer you to my YouTube channel. Go and it's just Kevin Wright Property. So get on YouTube, Kevin Wright Property. You'll find it easily enough. And there's a video called The 5 Types of Bridging, because pretty much every bridging loan you could think of doing is got to fit into one of 5 types. And a refurb bridge is one of those. That's where you borrow 70% of the purchase price and 100% of the refurb costs. So you bought a property, you put your deposit down, the bridger has now funded the refurb. The question here is, now that refurb work is done, how long does it take the funds to be released? Now, I'm not quite sure on the question here, because I'm just, as I'm reading this and I'm talking, I can think of 2 angles. Are you talking about the bridger releasing the refurb funds, or are you talking about getting a mortgage to pay off the bridging loan? Not quite sure on that. Maybe you want to put another comment in there to clarify that. Because if it's the refurb funds, if the bridger's refurb funds, then they'll be as soon as you ask the valuer to come back and look at, they'll be there, within a matter of days. Okay. Oh, it's Leon you. Okay. Yes. It just comes up as Facebook user. Well, as you can see, it's on screen. Okay. So, okay. Now, okay. Thanks for the extra clarification, Leon. So with a refurb bridge, then it's paid in stages in arrears. So if it's something like a very small refurb, £10,000, £12,000, you use your own cash to do that. The valuer would come back out, check the work's done, and sign that off. So that usually comes. So the funds are usually released to you within a few days, Leon, on that. If it's a bigger refurb, then you might have staged payments. So let's say it's a 30 grand refurb, you might have 3 tranches of 10 grand. So you'd have done some of the work for the refurb. Let's say you spent about 10 grand of your own cash. You ask for the valuer to come and check it out. They'll be there literally within a few days. They come fairly quickly. Sign off your work. Say to the bridger, okay, it's okay to release the funds. So you get 10 grand of funds released. Again, literally within days. You'd crack on with the next stage of the refurb, and that would repeat itself on a 30 grand refurb with 10 grand withdrawal tranches. Then that would happen 3 times. So there we are. Good. Thanks for your question, Leon. Good to know it's you. Okay, so we've got another question, and we got Valims. There we are. Good to see you. Okay. So thanks for your question. Anyone else got any questions? Then pop them in and far away, and certainly be able to answer them. Okay. So when applying for a mortgage after taking bridging finance, does the lender somehow consider bridging finance as a liability, or they don't pay attention to it as it will automatically paid off after the mortgage approved? Well, clearly that the point of you getting the mortgage is to pay off the bridging finance. So you're not going to have both loans outstanding, because one wouldn't allow, neither is going to allow it. A bridger's not going to allow a mortgage lender to take a charge, a second charge, and a mortgage lender's not want to go second behind a bridger. So it is a case of one cancelling out the other. And in essence, it's no different to if you're remortgaging, because if you own a property and you're getting a new mortgage on it, then you're going to pay off the old mortgage with the new mortgage. So mortgage lenders understand this. Yeah, so it's not really an issue, Vadims, but brilliant. Thanks for that question. So Peter's back with another question. Thanks for that, Peter. And I can see Jerry's popped in with the question, which we're going to come to Next, okay. So one concern you've got with buy, refurb, refinance is quickly building a portfolio at say 75%. Then we have a bit of a market crash pushing the loan to value above that. Okay. Should this be a concern, and what's the lender's position? Well, so you've got, let's say you've got a few properties that you've built up, you've done buy, refurb, refinance, and all of that. And yeah, there's a bit of a slump in the market. So you're now not at 75%. Let's say you're at 85%. Okay. Now, that's not going to be a concern unless you're looking to refinance. So as long as you stick with your current lender, then there shouldn't be any issues. So, you know, mortgage lenders, you know, which we say in business and trading mortgage lenders, and I'll explain what I mean by that in a minute, would quite naturally just let things tick over. They're not going to be checking their portfolio on a regular basis to see if the loan to value is still intact on where they thought it was. So, excuse me, quick slurp. So, no, that's not going to be an issue, really. Where it has been an issue is going back to the credit crunch over 10 years ago, where so many lenders just shut up shop and stopped lending, and became what we call zombie lenders. So they're just managing down, closing it down their mortgage book over a number of years. Then they, as a way of forcing some of that to happen, and Mortgage Express was probably the biggest exponent of this. You know, they would demand that you paid for them to revalue your properties, and if it showed that they were above the threshold loan to value, they would require you to put some cash in to bring it back to the required level, or they would just repossess. So they were just using it really as as leverage to repossess some properties and close their book down faster. But a standard buy-to-let mortgage lender that's still trading, still accepting business, is not going to be overly concerned about what would be a temporary dip in the market. So, you know, property values go up and down depending on market conditions, and sometimes properties are going to be above their loan to value threshold, but they'll just sit and ride it out. So nothing to be overly concerned about that, Peter, but thanks for your question. Okay, got a few more people in now. So if you're enjoying this and you got a question, pop it in there. So a couple from Jerry here now. Okay, Jerry, yeah, I'm very well, thank you, Jerry. Thanks for asking. Okay, on development bridging, will the bridger give a projected valuation to ensure the borrower can exit the bridge upon refinance or sale? Well, you know, if you're on that, then they're going to be working. You're going to be suggesting what the projected valuation is, and they will be verifying it or disagreeing with it. So, yeah, they would give a projected valuation, but you shouldn't rely purely on that. You should be doing your own due diligence to make sure that you're going to make a big enough margin to make the profit and the return that you want. So there we are. And then you've got a second part of that question there. In that case, is it important to get a professional valuer to give a projected valuation on an HMO or breast? Okay, so now then I understand what you're saying here. So now bridges are going to be looking at the end value. If they're funding the development bridging, you know, I mean, you could call it development finance or a refurb bridge, actually. If they're funding the refurb costs, they're going to be very keen to look at what the end value is, so they don't overfund you and put themselves in a vulnerable position in terms of getting their money back. So now, if it's an HMO, again, it depends what building, what you're doing, what you're building, what you're converting or whatever. So HMOs. Now, the thing with HMOs is that people often, I don't know about yourself, Jerry, but people often are relying on it to be valued on its income, not a bricks and mortar valuation. And of course, a lot of HMOs aren't. They're valued as on bricks and mortar basis because they're essentially still a residential property. And that's how they would be sold if it was repossessed. So, if it's important for you to get the right uplifted value, right end value, right done up value, then I would suggest you do pull in a RICS valuer, Royal Institute of Chartered Surveyors, RICS valuer, to satisfy yourself before you commit, because the bridger is just interested in getting their money back. They're not so interested in how much cash you leave in the deal. So you might be able to get a mortgage on it, but it might be enough to clear the bridging finance, but actually you're going to leave a big chunk of cash in the deal. Now, the bridgers are not really concerned about that, but you might be very concerned about that, because if you're leaving 50 grand in a deal, that could make your future projects far more precarious, because you need to get more of your money recycled out. So if that's the thinking behind your question, Jerry, then yeah, definitely get a RICS valuer in, and give them a work schedule, engage them to work for you, and they'll get give you a projected valuation, and they'll also tell you whether it's realistic to expect a bricks and mortar valuation or a commercial valuation. So I wouldn't be leaving it to the bridger. The bridger's concern is, can you pay us back? Your concern is, can I pay them back, and how much cash am I going to leave in the deal? Yeah. Okay, so thanks for your question, Bilal. We'll come to that in a minute. And yeah, you got a RICS value already, but you're checking to see if it's worth the expense. I would say yes. It's a few £100, but it's it's a worthwhile. Sometimes people can be too penny pinching, and to use that old saying, you're cutting off your nose to spite your face. So if it's important to learn how much cash you're going to trap in the deal, rather than can you pay the bridging loan off, then yeah, I think it's a worthwhile expense. And Jerry, no problem. Very happy to help you on that. Glad you got the answer you wanted, Peter. That's good. Happy to be of help. Okay, so moving on now. We've got Bilal. Good to see you. Thanks for your question. Which lenders lend to a limited company that has a holding company above it? This is for vanilla buy-to-lets. I hear lenders aren't fans of holding companies. Bilal, you hear correct. And in fact, I've done a video on my YouTube channel that explains exactly why that's the case. So when we're finished here, hop over to, you're on YouTube anyway, you're coming through YouTube. So check out my YouTube channel and find out, and scroll down, look for the video. There's quite a few on there, but look for the video that says why holding companies are dangerous. I understand that accountants advise you to do this because it's quite tax efficient, but actually you're never going to keep all the tax you made, because you're going to give most of the tax that you've saved by higher mortgage costs. I would suggest that rather than searching around for the odd lender that's going to charge you a much higher rate to have a limited have a holding company structure, just dump the holding company structure, and you'll get a whole range of lenders that will lend to limited companies. So I think you're going at it the wrong way round. You have seen the video, right? Okay, yeah. So I think it's a false game. But if you're really, if that's the way you want to go, because you think you're going to save so much tax, then just fire me a message on my Facebook group, Kevin Wright Property Finance. Show us the Kevin Wright Property Finance Expert. Show us the deal that you want to get funded, and we'll find a lender for you. Just don't expect it to be cheap. Good. So, but there are very valid reasons. Is because holding companies. Yeah. Okay. So, you're popping up. Yeah, you haven't formed a holding company yet, but you was advised to buy an account. Yeah, I know. The accountants are doing this a lot, but what they're doing they're only looking at one side of the coin. They're only looking at how much tax can you save, but it's a two-sided coin. And the question is, how much tax are you going to save, but how much of that tax are you going to lose anyway by the other side of the coin, which is how much is your mortgage cost going to increase. So I would suggest that you go back to your accountant, Bilal, and get them to give you a figure of how much tax you are going to save by doing this. And then if you want to come to us, we'll look around. Once you've completed one of our fact finds, our brokerage would look around and tell you how much extra mortgage costs you're going to have. So if you want to do that, that's fine. But I think it's important. You never ignore an accountant's advice, because they're doing, they're fulfilling their remit, which is to save you tax. But when you're looking at mortgages, and if you didn't need mortgages, then that's an absolute no-brainer. That's what you do if you were just a cash buyer on that. But if you're leveraging your portfolio with mortgages, then you need to balance both sets of arguments. How much tax you're going to pay, how much are your mortgage costs going to increase, and you'd be balanced by the two. But good. Thanks for your question. Good. Okay. So another one here from Vadims. Okay. So I'm very pleased to answer your first question. Is there a difference between borrowing bridging company as a private individual or as a limited company? No, none at all. Bridging lenders don't care whether you borrow in your personal name or a limited company. Makes absolutely no difference whatsoever. So there we are. That's a very easy question. Below, it's annoying that property accountants are not. I think that it's annoying that they're not clued up on the financing side. Well, it's understandable, really. I mean, finance brokers are not clued up on the accounting side. So I mean, you could level the same accusation, at brokers, because we each have our speciality. So it's a question of getting, two opinions that you trust, your accountant and a broker's, and putting the two together and working it out for yourself. So understand that. So it's coming up to 9 o'clock. We can probably squeeze another question or two in there if anyone's got one. There's a few people watching this now live that we'll just get rid of that one. So some good questions so far today. So that's been good. So here's your chance. If you've got a question, then pop it in there, and I'll answer it for you. Yeah, I knew you meant aunt, Bilal. Yeah, Bilal was just done a little correction there. Yeah. So if you're enjoying this, and actually I've got a Facebook group, which is Recycle Your Cash. You're welcome to come over and join that. Let me just find a link, and I'll pop that into, where are we on that? Pop that into the chat box. So let's just go and find that. Just hooking that over from Facebook and popping that in there. So it's free to join. If you like the sort of stuff that's going on here, then feel free to There we are. Good. There we are. So if you like this, come and join my my property finance group, Recycle Your Cash. That's what I've been teaching people to do for the last 7 or 8 years, formally. So and there's a group of other ambitious property investors that want to get on and want to progress. So come and join them, and you'll like that. So okay, so Bilal was saying this is your first question time, but you watched all your videos at least 2 or 3 times. Wow. Thank you very much. That's I mean, there's over 60 videos on there, and if you watch them 2 or 3 times, well, that's a serious time commitment, isn't it? So I'm very grateful. Thank you very much. And it's your first time on the live chat and you love it. Brilliant. Yeah, I love you being here. So that's great. So there we go. So we're coming up to 9 o'clock now. Yeah. So I just do this for about 30 minutes on a Monday morning. Kicks off the week rather nicely, I think. And oh, and Bilal, if you're liking this, then come on next Monday, and I'll see you next Monday. And and feel free to come over and join me in my Recycle Your Cash Facebook group. You'd be very welcome there too. So there we are, guys and girls. Hope you've enjoyed our brief chat together, and you've had some stuff that will kick off the week for you. So I wish you a really good week. Have a great week in property or whatever it is you're doing this week. If we have some sunny weather, enjoy that too. And I'll be back next Monday, 8:30, for another property finance chat. So thanks a lot. See you guys next week.